Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll be discussing one question of cost sheet based on dual pricing. Now what is dual pricing? Dual pricing means same product is sold in the market at two different prices. This is possible when government is administrating the prices for a product. Those are essential commodities of the life. For example, sugar. Sugar is essential product, so government may dictate the price at which sugar has to be sold in a particular market. Now in this case, company will require to sold particular quantity produced at government price, and the balance output it can sold in open market at any price which is determined by demand and supply forces. Let us read the question. The state government granted license to Sweet Sugar Limited to manufacture and sell sugar with a stipulation. The word stipulation means condition that 40% of the output should be sold to the state government at a controlled price of rupees 3000 per ton. Controlled price means government fixed price. It is a price at which manufacturer has required to compulsory sell output to the government. So it is given rupees 3000 per ton, and the balance will be 60% of the output can be sold in open market at any price, that is price at wish of the manufacturer. Following are the details of Sweet Sugar Limited for the year ended 31st March 2014. During the year, 3600 tons of sugarcane was consumed. Sugarcane is a basic raw material required to produce sugar. They have said 3600 tons of sugarcane is used. It will be part of direct material at the rate of 1000 per ton. Direct labor amounted to rupees 825 per ton of sugar produced. So it is based on final output. The details of other expenses are as follows. Direct expenses, telephone charges, administration overheads, office computer purchased. This is a purchase of asset. So it's a capital expenditure. So it will not be recorded in cost sheet. Factory, rent and insurance, factory overheads. Machinery purchase, it is a purchase of asset not recorded in cost sheet. Machinery repairs, factory overheads. Commission on sales, selling overheads. Factory salaries, factory overheads. Carriage outwards, selling overheads. Packing expenses, selling overheads. Bank interest is a financial expense. It will not be recorded in cost sheet. Factory electricity, factory overheads. Delivery van expenses, selling and distribution overheads. Coal consumed, factory overheads. Depreciation on machinery, factory overheads. Depreciation on computer, administration overheads. Depreciation on delivery van, selling overheads. Office salaries, administration overheads. Printing and stationery, administration overheads. During the year 2400 tons of sugar was produced. So total output is 2400 tons. Total sugar produced is 2400 tons. As per the license condition, you are required to sell 40% to government. So 40% comes to 960 tons. It will be sold to government. Balance 60% comes to 1440 tons. It will be sold in open market. The company's profit target for the year for fixing the open market selling price on the basis of cost sheet is 10% of its average paid up capital of rupees 1 crore 42 lakhs 56,000. Company share capital 1 crore 42 lakh 56,000. 10% of it. So expected profit will be 14 lakh 25,600. Prepare cost sheet and find various components of total cost per unit cost and suggest the selling price in open market. We have discussed all the elements of question. Let us start doing cost sheet. Direct material 3600 tons of sugarcane at the rate of 1000 per ton. It will be rupees 36 lakhs. During the year 2400 tons of sugar was produced. So we can calculate per unit direct material cost. Direct labor amounted to rupees 825 per ton of sugar produced. So it will be 2400 multiplied by 825, 19 lakh 80,000. Per unit it will be 825 rupees. Direct expenses 4 lakh 20,000. So we got prime cost 60 lakhs, per unit 2500. To this we will be adding factory overheads. Factory rent and insurance 3,54,760. Factory salaries 2,19,588. Factory electricity 2,61,880. Coal consumed 3,80,125. Depreciation on machinery 2,49,600. We can add all factory overheads. Per unit factory overheads 610 rupees 81 paise. Per unit works cost 3,110 81 paise. To this we are going to add office and administration overheads. Office and administration overheads, telephone charges 3,52,695. Depreciation on computer 2,04,180. Office salaries 1,89,325. Printing and stationery 1,13,000. We can add all administration overheads. Total administration overheads 8,59,200 per unit 358. By adding this to works cost, we get cost of production 83,25,153. Per unit it will be 3,468 rupees 81 paise. This is we got cost of production or cost of goods sold. To this we are required to add selling overheads. Commission on sales 3,37,650. Carriage outwards 1,54,090. Packing expenses 194,450. Packing expenses 1,94,450. Delivery van expenses 1,06,850. Depreciation on delivery van 1,57,360. We can add all selling overheads. Total selling overheads 9,50,400. Per unit it will be 396. We got total cost or cost of sales 92,75,553. Per unit it will be 3,864.81 paise. Now out of this, some units are required to be sold to the government. As per the information in the question, we are required to sell 40% of the output to government, which comes to 960 tons. And the selling price for this 40%, as given in the question, control price of rupees 3,000 per ton. There is sale to government at the rate of 3,000 per ton. It comes to 28,80,000. So from total cost we have deducted that recovered amount. So balance cost remains 63,95,553. To this we are required to add target profit. We have calculated target profit 10% of 1 crore 42 lakh 56,000, which comes to 14 lakh 25,600. It will be added to cost. Open market price will be fixed, taking into account this target profit. Anyhow, we are required to earn this amount of profit. So required sales is 78 lakh 21,153 by sale of 1,440 tons of sugar. So selling price per ton here would be 5,431.35 paise. This is how we can ensure target profit when we are required to sell our output to government at a loss. This is what we have studied in this question. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.